Hey everyone, and welcome to the LizardTrader webinar. We are coming to you here today from Berlin, Germany. My name is Chris Lassen. We've had some fantastic fall weather over here lately, so now the time has just been dialed back last weekend, and we're headed into winter time. I personally don't mind so much. I lived in California for a couple of years, and could never really get used to living without season. So I'm pretty happy to see winter coming now. Okay, so great to see that so many of you could make it here today. Presentation will be about 60 minutes, probably a little bit less. I'm not the guy that goes on and on with the webinar. I like to keep things pretty short and sweet. So it's going to be a condensed webinar with a lot of good information for you here, I think. I'm not all too good at small talk, so I thought I'd just start off with how we came up with the LizardTrader name here today. Most of the time, it looks like these lizards, they're just sitting around not doing much, but they're really patiently listening and looking carefully for opportunities to grab what's right in front of them. So they've used this simple survival technique for more than 200 million years. And as traders, I think there might be something to be learned here. We might want to use a similar strategy. So you definitely don't want to run around chasing after the market. You want to be patient and really let the opportunities come your way. And really want to also be very focused on preserving energy, or capital in our case, so limiting risk. Okay, so to do that, we want to identify and look for market patterns and trading setups that we know have a high probability of succeeding. So if you've seen one of my previous presentations, you'll definitely recognize the concept presented here today. It is pretty easy to understand and execute. We're looking for a price action setup, which is very versatile and that can be used across many markets and instruments. Okay, so a quick intro on the LizardTrader team. We are, as I mentioned, based in Berlin, Germany. Most of you will be familiar with Harry, also known as Fat Tails. He is well known throughout the NinjaTrader community, both in the NinjaTrader support forum and over at what used to be Big Mike Trading. He has programmed some of the most downloaded indicators for the NinjaTrader platform, including the tools that we'll present here today. As for myself, I am the co-founder and CEO of LizardTrader. I have a background in system trading. Had a company that focused on market sentiment data. We had an algorithm that automatically read sentiment data out of financial news, and then we sold this data to institutional investors and managed futures products and traders. And yeah, this company got bought up by a Swiss investment firm last year. And as I'm a little bit too young to retire yet, I co-founded LizardTrader with Harry soon thereafter. Okay, so an outline of what we'll be going over here today is really to introduce the concept of leading indicators. So by the end of this webinar, you will know what this is all about and how to apply leading indicators in a profitable trading strategy for crude oil futures. We will then look at predefined price levels where institutional investors are likely to participate in the market action, and show how this can help us identify market entry and exit points with a favorable risk-reward profile. We will then go over a tool for timing our entries, the Zerolag Oscillator. We'll look at how to set some simple rules for your trading setups and really check the conditions that you want to see before you enter a trade. We've also done a backtest for this trading strategy to verify that we're looking at a sound concept here. And towards the end, we'll also have a look at some trades that we took last week on this. We'll also have a special offer for you with a deep discount on our indicator package with some special bonuses as well. So make sure that you stick around until the end for that. Now, we both have novice and advanced traders with us here today. So one of my challenges will be to balance the presentation and keep it interesting for everyone. So if you're a advanced user, and if you've seen a couple of my previous presentations, then you'll have to bear with me if I go over some things that you've already heard of and that may be obvious to you. And if you're at the other end of the spectrum and seeing this for the first time, there will be a Q&A session towards the end where we can tie up any loose ends. And I'm not going to answer questions during the presentation here, as I will be focusing on presenting the concepts here. But if you have any questions that come up along the way, just type them in to the chat box, and then we'll circle back to that during the Q&A session. Okay, so I see some of you are getting a bit impatient here already. Get started. There's just one last thing I need to add before we get going, and that is our disclaimer here saying that trading is associated with considerable risk. So make sure that you understand that, and keep in mind that the results from the trading strategy that we're going over here today are hypothetical and not based on actual performance. Okay, so leading indicators. First of all, in order to be a leading indicator, we want to have two basic criteria met. So we want them to be sort of like a self-fulfilling prophecy, and use a concept that is really very well established in the trading community. So looking at some secret holy grail indicator or a black box system with some exotic bar calculations will really have limited value, because higher time frame traders don't really look at that stuff, and you want to base your decisions on what's commonly accepted as trusted price levels in the professional trading community, because collective action in this area is really what will make the prices move. And that brings us to the second requirement for being a leading indicator. The price levels have to be objective. So in order to be a meeting point for buyers and sellers, we all need to be looking at the same price levels, and only then can there be an agreement on where and how to react to this price action. And that really goes to the core of what technical trading is all about, and that's herd mentality. Technical trading works because enough traders react in a coordinated way when looking at certain chart patterns and support and resistance levels. So this is the one and only goal of technical analysis, really, to identify setups where the decisions will be the same. So important to use tools that other traders use and make sure that everyone is looking at the same picture. That's really a common problem for a lot of indicators that people are using. Moving averages, for example, everyone think that they're looking at objective price levels, but they're really quite subjective. Subjective in terms of the calculation period that you use, or the formulas that you use to calculate the moving averages, or the bar types that you put this on. So all of this is going to produce different price levels, and you can use this for as a trend filter, of course, and I would not recommend using it as a basis for entry or for support and resistance. Okay, so the two price benchmarks that I will be talking about for the next few minutes are very well established and produce the same price levels for everyone. And the first one is the pivot calculation. It's very easy and straightforward. That has a long tradition, and I think it is as subjective as they objective as they come. This calculation is based on the high and the low and the close levels of the previous trading session, so that makes it completely transparent in terms of how support and resistance levels are established. The second one is the volume weighted average price. That is the arithmetical mean of all transactions that take place over a defined period. So you can calculate the volume weighted average price for all instruments as long as price and volume data is available. And yeah, I think it's a pretty poorly kept secret that this is a institutional benchmark to measure execution costs. So brokers and large traders have developed sophisticated order execution algorithms to achieve VWAP, or volume weighted average price of the day, or better. So this is also now becoming available at the retail level. So it really shows how well established this concept is. So we know that there will be price action when the market interacts with the session pivot and VWAP levels, because there's a lot of traders that will be looking at the same information and have a predefined idea of what to do next, and that will make it really easier for us to spot entry and exit points with the favorable risk-reward profile. All right, so this is the volume weighted average price with standard deviation bands above and below it. The VWAP calculation is anchored at the start of the period for which the transactions are being recorded. So you can anchor it for any standard period, such as a trading day or a trading week or a trading month. But I think as a day trader, the most important indicator in the VWAP family will be the daily calculation. So here we see a crude oil futures contract in a 5-minute chart. The VWAP calculation starts with the first transaction of the current trading day, and it will end with the last transaction prior to market close. And so during the trading day, the VWAP will put on weight, and it will gradually stabilize. And the more weight it puts on, the more significant it will become as a benchmark, and it will be better as a technical trading tool. And so what we'll do here is really to use the first standard deviation bands to represent a value area. And that's really because about 70% of all transactions during a day will take place in this area. And that's where we're likely to catch new trends early on. So if we're in an uptrend, we'll look to buy when the price is retracing back down to the value area here, and taking advantage of prices close or below the daily average. So this indicator, it also shows us VWAP levels of previous days that often represent important areas of support and resistance. And at the outset here, we see we had a test of the VWAP level of 3 days ago, and then the price oriented itself around the VWAP of yesterday before finally testing the VWAP level of 2 days ago up here. So as you see, these are important meeting points for buyers and sellers, and you want to make sure that you're trading at the right side of these levels. So if we're going into a previous VWAP level from below, it will be resistance, and we're looking to go short or exit any open long position. And if we're coming in from above, it will be support, and we're looking to exit any short trade or enter long. So this is basically buying support and selling resistance that we're talking about here. All right, the other price benchmark that we are looking at is the pivot point indicator. Many of you are familiar with this, so I'll just do a quick rundown on what this is all about. Before we had technical chart analysts and electronic exchanges, floor traders used this simple calculation to determine buy and sell levels throughout the trading day. There's not really a big secret here. We're working with a range calculation of yesterday's price action to produce these support and resistance levels. And what we're doing is taking the high and the low and the close of yesterday, dividing by 3, and then we get the pivot point. And by adding mathematical calculations to this level, we then create support and resistance levels above and below. So because this concept has really long tradition and really has very widespread use, pivot levels have turned into something of a self-fulfilling prophecy, and we're likely to see a reaction when the prices reach and interact with these levels. So again, we're looking to buy support and sell resistance. So here we see the price is moving above the pivot, and then it's testing support at this level, and then there is a brief consolidation around the first resistance level before the price is gravitating towards yesterday's high level. And finally, then we have a test of the second resistance level, and then a retracement back down to the pivot. It's really quite rare that the price will move beyond the second support and resistance levels, as this is representing the entire trading range of the previous session. So it will go beyond these levels at times when there is a big news story or some event that really creates a breakout to beyond the range of last session. Okay, so the reason why we want to buy support and sell resistance is to avoid this type of situation, which is usually what happens to inexperienced traders. Resistance is really where sellers are looking to cash in on their profits and often overwhelm the buyers, so causing a price imbalance and causing a pullback. And support, on the other hand, is where the bargain hunters are going to overwhelm the seller and causing a bounce and prices to go up. So what we want to do before entering any trade is really to check that we're not trading straight into any pivot or VWAP support and resistance levels. The reason is that we're very likely to see pullbacks and bounces following tests of these levels. So we are going to filter the trades by saying that if the price moves within a certain distance of a support level, we will only take long trades or exit short. And if we're going straight into a resistance area, we will only look at short setups or exit long. Okay, so the idea here is then really to measure how far we are away from these levels before we're taking a trade. And by doing that, we can start comparing with the distance to our stop loss. And that's how we get the risk-reward ratio for our trade. So potential gain should always exceed risk, of course. And at a minimum, it should be a 1 to 2, but probably more something like a 1 to 3 or 1 to 4 ratio. And I'll show this in a chart later on to add some more color to this slide. All right, so into the charts. As I mentioned in the beginning, we are choosing our entry signals using the Zerolag Oscillator. It has three main features. It has a trend filter, a histogram, and price action signals. So if we have a 5-minute chart of the crude oil contract, the Zerolag trend filter is down here, and so if it's a red line, then we're in short modus, and if it's green, then we're looking to go long. And what we're really looking for are these retracements into the main trend, and these are signals that will allow us to work with fairly tight stops and lock in high rewards when we're right about entry timing. So the idea here is really to step into a market when the trend is about to establish itself. We don't want to get into something that is over the hill, so to speak. Ideally, we want to participate in the main chunk of it. So if we're in an uptrend like we see later on in the session here, we're looking for a short-term oversold situation. So the histogram is going to alert us to a situation like this by plotting a white bar like this one. And we then know that there's a pullback into the trend and that a trade setup might might be coming up. So after the first white bar has plotted on the chart, the Zerolag Oscillator will start looking for a sign that buyers are taking advantage of these lower prices in a continuation of the trend. So if we see a up thrust bar with a close above the previous high, or a histogram bar which is higher than the previous one, the Zerolag will plot a lime green confirmation bar, and then we enter long at the close of this bar. And we then set a stop below the low of the signal bar or the prior bar, whichever is lowest. So as we see here, this coincided with the VWAP band of yesterday, so that gives us extra support and a higher probability for this trade. And later on, we also see another setup. Up here, we see some white bars. And there are a couple of reasons as to why we don't get a signal here. So first of all, we're not in the value area of the volume weighted average price. And this is an area where we'd be chasing the trade. And that's not something that you'll want to be doing. We want to be like the lizard hanging out in the value zone here, patiently waiting for the price to retrace. And the Zerolag also has a threshold filter that really eliminates signals that come when the trend is likely to have climaxed. So this will prevent us from getting in when the trend is over the hill. So the threshold is also eliminating this setup here. And finally, and most importantly, there is also no upthrust bar here. There is not a close above the high of the setup bar, so that invalidates this setup. All right, so back to the pivots. This is the same trade, and I always want to check and make sure that we're on the right side of any of these levels, especially when we're in a market dominated by traders that have a strong tradition for using pivot levels to determine buy and sell levels. And although there is no floor trading going on anymore, this is a tradition that really remains strong, and institutional traders will use the high and the low and the close of yesterday's trading session to enter and exit their trades. So as we see here, the market broke above the pivot, and so it's working as additional support for our stop here. And by comparing this, the distance from the stop to the entry, we then get our risk for this trade. We then look to see what the distance is from our entry price to the first significant resistance level, which is up here, and this is the possible reward for this trade. And comparing the two, we then get our risk-reward ratio. And in this case, we had a risk-reward ratio about 1 to 4 to the first resistance level here, and about 1 to 2.5 to the high level of yesterday. All right. So for the downtrend, we are looking for short signals when the zero line is red. A retracement setup will then occur when there's a short-term overbought situation in a downtrend. So a setup signal will be a yellow bar signaling a pullback into the trend, and here we see there was no confirmation of this trend, and that instead we had a trend change, and that went straight up to the VWAP level of yesterday. And the market then retraced back to this session's VWAP band, where it consolidated, and then as the market broke to the downside of this level, we were setting up for our trade here. And as the market retested the VWAP from below, we saw these 3 yellow setup bars and then a down thrust bar confirming renewed selling pressure. And so the stop was then set above the high of the previous bar. And on the chart here, we also see a weak retracement signal earlier on, and that's I will come back to that later and explain what a weak retracement signal is. But I think you get the gist of this. It's pretty much the inverse of the long signal, what we're looking at here. Okay, so we then go back into the pivot chart, and we check and make sure that we're on the right side of any pivot level here. We're trading below the pivot, and the distance from our entry to the stop loss is 15 ticks. So that's our risk on this trade. And next, we look to check the distance from our entry price to the first resistance level. And here we see that yesterday's close and low levels coincide with the midpoint between the pivot and first resistance level. And this is then really the first logical profit target, and what we'll use to calculate our possible reward on this trade. So here it's 46 ticks and a bit more than a risk reward ratio of 1 to 3 on this one. So earlier we saw a setup bar up here, but this was blocked by the trend filter down here, which was in green. So if the trend filter is green, then we will block any short signals, and if it's red, then any long signals will be blocked. All right, so that's pretty much it for the strategy overview here. It's like I mentioned, fairly straightforward and a simple concept. Just to summarize the strategy, we want to have the price within 1 standard deviation of the daily VWAP. That is where the lizard traders are hanging out, in the value zone. And we want to time our signals based on the Zerolag Oscillator, looking for these retracements into the trend, and then control our risk reward ratio by taking trades that allow for tight stops and high rewards as defined by the landmark support and resistance levels with the previous VWAPs and the current pivot levels. All right, so a quick overview of the back test that I've done for this. This is the CL contract, 1 year. I've previously done webinars on a variation of this concept for E-minis and Forex. Every market has its signature, of course, so you need to adapt a little bit for volatility and some other things. So, but with one contract here, we're just shy of 13,000 over the last year, and then you need to subtract for slippage and commissions on this as well. And I've not added this as I've tested with a hard stop loss and profit target setting, just to keep the condition as simple as possible to test the concept for robustness across asset classes. So we're working with a stop loss and profit target setting of 4 to 2 ATR of the last 50 bars. And walk forward testing is really showing better performance with the tighter stops and these profit targets set at landmark support and resistance levels. And we then also use pyramiding signals, adding to open positions and trailing the stop. So another element which is really important here when you trade, and if you want to apply this to your own setup, then you need to be aware of the time filter that we're using for this template. So we will only open positions for this 30 minutes into the regular session, and we will stop trading 30 minutes before close of the regular session. All right, so this is a pretty consistent and stable performance curve. Again, this is not optimized with the stop loss and profit target settings that I mentioned earlier. So for those of you who are not familiar with the Bloodhound add-on to NinjaTrader, you're probably wondering how I've put this strategy together. And yeah, Bloodhound is a visual programming tool which makes it quite easy to create and test trading strategies in NinjaTrader. And so if you have Bloodhound, you can use this template I've created here together with the LizardTrader indicators one-to-one. Okay, so this is what the logical tree looks like in Bloodhound. So what you see here are the conditions and the parameters defining the strategy with the VWAP value zone, the zero lag retracements, and the landmark support and resistance levels that I've talked about. So I think you probably have a pretty good idea by now why it makes sense to work with these concepts. A lot of people, as I mentioned, are out there looking for the latest holy grail or some secret indicator to give them an edge, but that's not really what technical trading is all about. You want to find these objective price levels that have widespread use and try to look at what institutional and higher time frame traders use as price reference points. And we'll then have a better idea of what the market will do next and position ourselves accordingly. And that's really what the VWAP and the pivot indicator can do for us. And then we use the Zerolag Oscillator to time our entries and define our risk reward ratio. But let's look at some trades and setups for that we had last week here. This here is Tuesday last week. So you see here the market is trading below the VWAP levels of the last few days. So we have the VWAP of 2 days ago and 3 days ago and yesterday up here. And now the price has just broken through the VWAP level of today here. Let's see if we can get my marker working here. Okay, so it's breaking through right here. And then we would have a stop set up here just above the high of the signal bar and the previous bar, and this down here would mark our entry point, and so that would be the risk for this trade. And we then want to go into the pivot chart and see if there is any landmark support levels that we're likely to run straight into. And indeed, we see the first support level is down here. We also have a close and a low level of yesterday, and the midpoint right in the middle here. So if you look at this from a risk-reward perspective, we have the risk up here, and then we add this box down here and here, and then have a risk-reward ratio to the first support level about 1 to 3, but we are also mindful of this level created by the midpoint and the close and the low of yesterday as being a potential obstacle. So being careful around this area here. Okay, so we will go back to the VWAP chart and go on to the next day here. which was Wednesday last week. Wednesday is weekly petroleum report, so news release that you want to be very mindful of, and this is occurring at 10:30 local time. So this is right around here, so you don't want to trade into anything like that. You see a signal right at the release of the report, so not something that you want to trade on. And fortunately, we had a nice long signal following this, so a stop on at the low of the previous from the signal bar, and then we had a entry up here. So quite a big move in the signal bar here, which is not really ideal, because that forces us to work with a bigger stop loss. So we have 45.43 on this one, and here we have a stop of 45.12. So a risk of about 30 ticks on this. We'll have to look at how this plays out in the pivot chart to calculate the risk reward. Let's see, here we go. And as you see here, this has really moved too much to be a favorable probability trade, as it is not even a one-to-one up to the first resistance level. This is a support level, but when the market is trading below this, it's obviously resistance. So be mindful of that. So what you could do in a situation like this is to say, okay, I'm willing to take this trade when it comes back to at least a 1-to-2 ratio. So we could do something like this. Just make sure that these are about the same to measure the correct risk reward ratio here. Okay, so we put that on top here, and then we'll add another one. So now we have a 1-to-2 ratio. So what we could do in this situation is to set a limit order around this area and say, okay, it moved a lot on the signal bar, in fact too much for it to be a favorable risk reward ratio. So let's see if it retraces some, and then unless it crosses into a downtrend, or the histogram crosses the zero line, then the setup will be invalidated altogether. But in this case, you see this would have worked out quite nicely, working with a limit order to make sure that you have a favorable risk reward ratio on this one. Okay, so I think we'll do one last example here before we go back into the slides. I wanted to present the offer that we're presenting here today as well. So yeah, this is a first we're being stopped out here. We have a stop set just below the low of the previous bar from the signal, and here would have been the entry up here. But as you see, this is not really a very good place to get in. We've just passed the VWAP level of 2 days ago over here, and we're trading straight into the VWAP level of 3 days ago. So this is something that you would want to pass on. This is not adding up from a risk-reward point of view. And then we have a weak retracement signal here, which I wanted to explain. A weak retracement signal is when it's something that you can activate in the Zerolag oscillator. So if you say that these yellow bars, they are too strict, the stochastics is too strict in defining these retracements. So in that case, you can allow for retracements that are not retracement bars that are not yellow. These are salmon-colored ones. It's have not really reached the overbought level. But if you have a confirmation bar after one of these, you would still get a signal. So I've not added this for the strategy template, but this is something that you can play around with and experiment with to loosen up the conditions a little bit of the strategy if you wish. So in this case, we would then let's just clean this up a little bit. We would set a stop right here on the VWAP level of 2 days ago, which is really quite nice support for our stop here, and then the entry would be at the close of the signal bar, and then we have, I think, enough distance on this to the first landmark VWAP level. So let's see here. We can build this together quickly in a visual way. Put this on top here. Okay, so you see here that this is going to be like a 1-to-3 ratio here. Okay, so but that's the VWAP level of yesterday, which is the first support level for this trade, and you see the price is really oscillating around this area for several hours, and then continuously retracing back into the value area of the VWAP band. And then let's head over to the pivot chart to check how it looks there. Yeah, so this is looking pretty good. We've just broken through a support level here. This was a resistance level, but when the price is moving above it, then it becomes support. And so here we have a good risk-reward ratio on this level, the pivot range down here. And yeah, this is pretty much the same story as in the VWAP chart. This is our risk. We have also support from our stop by this resistance level up here. And we add this and we arrive at the acceptable risk-reward ratio on this. All right, so I think that's it for the examples that I wanted to cover here today. I'm now going back into the slides. I'll talk a little bit about the offer that we have prepared for you guys to. I think this is where we left off. And let me pull this back into the right monitor. And okay, so here's the deal. If you decide that this is something for you, we are basically throwing in Bloodhound here basically for free today. You can then start trading this setup right away. As I mentioned, I've been working for strategies with trading strategies for years, and I can tell you that it's really helpful to be working with Bloodhound. I'm not a programmer myself, so this is very helpful in structuring and backtesting my ideas about trading and trading setups. And you can also use this to set alerts for when a setup appears, so you don't have to sit glued in front of your trading machine all day waiting for something to happen. Bloodhound also has a great support team and weekly workshop classes to help you get going on this. So can really recommend to start using this as a part of getting more professional about your trading career. But as I mentioned, we've also added two really cool bonuses here today. The first is the session template handbook that we've written. And this is really useful if you're working with the session indicators. And this is going to show you how to isolate specific trading sessions where institutional traders are active, and especially useful for the session pivot indicator. Another reason, of course, that you want to make sure that your session templates are set up correctly is what we're seeing this week. We have daylight savings time change in Europe. So normally we have a 6-hour time difference between European Central Time and Eastern Standard Time. But this week it's 5 hours. So if you're trading markets that are overseas, you want to make sure that you're referencing the exchange time in your session templates and not your local computer time, because then you'll have wrong open and close times, which of course is a problem if you're trading the regular hours, or if you're using the open and close and the high and the low of those times to define your support and resistance levels. So all of this is explained in our handbook, a very useful tool. And we've, of course, thrown in the strategy template as well. So basically, everything that I talked about here today is included in the package here, and will help you implement this approach very quickly. And for those of you that don't have Bloodhound already, the normal price for all of this is just shy of $1,400. So at a total price of $895 here today, we have about 35% off the normal price. So that really means that you get Bloodhound for free with this package. As I guess you've noticed, I'm completely convinced that the Bloodhound add-on will make you more structured and disciplined about how you think about trading, setups, and execution. So I can only recommend this. What else is in the package? Well, the session VWAPs contains the daily VWAP calculation. We also have weekly, monthly, and rolling VWAPs. We also have range-weighted average price, which is very useful if you're working with instruments and markets that have limited or incomplete volume information, and you can replace the VWAP with the range-weighted average price. And of course, we also have the origin of this concept, the TWAP package in here. For the pivots, it's similar. We have daily pivots calculations. We have weekly and monthly ones. We have rolling pivots. And we also have the Jackson zones, which is a variation of the traditional pivot calculation. The zero lag, I think I've gone into that in quite some depth here today. The Zerolag Oscillator contains the trend filter, the histogram setup bars, and of course the price signals. And of course, Bloodhound is in here. You get the handbook and the strategy template, all of it for $895. All right, for existing Bloodhound customers that don't have the LizardTrader indicator package, you get an additional $300 off, so a total of $595 here. And you then get the session indicators, the Zerolag Oscillator, the strategy template, and our session template handbook. So this offer will be good until midnight, so don't delay if this is something that you're interested in. Actually, you might have a bit more time than until midnight because of the time difference here. It's now 10:30 in the evening here in Berlin, so we'll probably won't close this down until tomorrow morning local time here. So another good reason to act on this is that NinjaTrader 8 is just around the corner. We'll update our indicator packages for that, and this will have to be reflected in our prices for the NinjaTrader 8 versions. So we expect prices to go up by 20 to 30%. But if you get in on this now, then there will be a free upgrade for the NinjaTrader 8 versions for existing customers when they become available. So some of you already have Bloodhound and some of the LizardTrader indicators. So we also have a mini offer of only the Zerolag and the strategy template at lizardtrader.com/webinar-offer. So head on over there and get your order in before it's too late. So now I'm going to open up for questions. And I see someone here is wondering, what is the difference between the VWAP and Bollinger Bands? They look similar. Yeah, that's a good question. So basically, before we had the powerful computers that we have today, indicators were really designed in a way to make them easy to calculate. So at the time, also volume data was not available in real time. So most indicators were based on daily price data only. So this led to oversimplifications, and I think the Bollinger Bands indicator is an example of this. And the problem with it is that it really treats all bars as equal. But as we all know, all bars are not equal, meaning that high volume bars should really receive more weight than low volume bars, both when calculating the mean and the standard deviation. So the Bollinger Bands only use the close value, and as a result, they don't respond very well during strong trends, and they also tend to overreact on the side which is opposite to the trend. So support and resistance don't match, and you will see that there's clearly more than 5% of the price data points outside the bands, which is statistically not correct. And you will also see, if you look at volume differences in intraday bars to the daily charts, the volume between the regular session and the pre-session, that will affect the accuracy of the Bollinger Bands considerably. Yeah, they just they don't plot the real statistical mean and standard deviation of the underlying trade. So the VWAP indicator is just much more accurate, as it assigns weight depending on the trade volume in each bar. So I hope that answers the questions. Maybe a little bit complicated, but I think that should be a good answer to the question. So there is a question on why is this trading approach better than any other? This might hurt my sales a little bit here today, but I guess yeah, in my book, honesty goes a long way. So well, basically the most difficult part of trading always comes back to interpreting the chart. So and then taking the trade, and then money management. And it's not just about the indicators we use. It's actually more about how the trade is managed. And that means if a particular method is working for someone, that's partly because the way it's being put to use, which is on the person, not necessarily on the method. So if a trader is having a difficulty in trading, looking for another better method might not be so helpful, because the problem might be with the trader, not with the method. So in very clear words, part of the success of any tool is in the use of the tool. And yeah, that's something that these holy grail vendors will never tell you, but that's actually very obvious. Can you explain more about the weak retracement signals? Okay, so I will do that real quick here. The weak retracement signal is what we had up here. Maybe I'll show it on this one where I haven't messed up the chart. So here we have two retracement signals after one another. We see here we've been in a downtrend, and the weak retracement signals are they basically come after the first retracement in a downtrend, and so it's considered weak because we have overbought conditions here that have not been detected by the fast stochastics. So the fast stochastics is telling us it's detecting overbought by pulling up these yellow bars here, and a weak retracement signal will allow a confirmation bar to dispatch a signal even though there was no overbought. It was retracing into the trend, but it had not yet reached overbought conditions. And we also have something that we call weak pyramiding signals. Let's see if we can find that somewhere here, because they are also something that can loosen up the entry conditions here for the trade. So here we have a weak pyramiding signal right here. So a weak pyramiding signal comes basically with a confirmation bar, which is 1 bar delayed when you compare this to an ordinary strong signal. So the color code for a weak long signal is then white, dark green, and then lime. So that is what you see in the histogram here. You see this dark green bar right here. Well, that was a arrow was not doing exactly what I wanted. So we have this bar right here, which is dark green. So we have white, dark green, and then we have a confirmation bar. Whereas normally you would have a situation like this one, where you have a white bar and then you have directly a lime green bar, which is the close above the high of the previous bar. And this is a indecision bar. So it was indecisive, and then we had a up close with 1 bar delayed. Okay, so I think that is pretty much it, what I had planned to present here today. I hope this has been of value. I will want to thank everyone for checking in, and yeah, there are some questions here that I haven't gotten around to answer. I will get back to all of you via email. So again, thanks for checking in today, and I hopefully look forward to welcoming you as a LizardTrader very soon. Thanks again. Take care, and bye-bye.